investment meeting of the NYCERS Board, April 28, 2015. Diane, can you please call the roll?
Chair.
Present.
Controller's Office. Here. Public Advocate's Office. Here. Borough President Manhattan. Borough President Brooklyn. Borough President Queens. Borough President Staten Island.
Here.
Borough President Bronx.
Here.
International Brotherhood of Teamsters. Here. Transport Workers Union.
Here.
District Council 37.
Present.
Thank you very much. Mr. Evans.
Thank you very much, Mr. Chairman.
Take us away.
We have a fairly long presentation for you today, all things considered, so we'll try to move through it quickly. We're going to start as usual in the flip book, January flip book. We'll go first to page 39. Get a quick look at the overall results. These results, of course, are gross of fees in public markets and net of fees in private markets. It is our commitment to you that starting with the June quarter report, we will be reporting going forward net of fees for both public and private, and it'll be easier to understand on a real-time basis where we are net of the fees and managers. But with our customary way of reporting, we're 6 basis points up, 283 versus 277 for the month. That's the third column in at the bottom of the page on page 39. And you can look through at the bottom in red and green to see the component pieces. Martin will talk a little bit about that as he goes through his comments. But I want to then turn to the asset allocation on page 32. And remember, our strategy is to be in line with our long-term asset allocation in the equities. Those are the boxes at the bottom of page 32 on the bottom. So if that number is 0, we are in line with our long-term asset allocation for that asset class. You can see we're a little above in the green and yellow. That's domestic equity and developed international equity. The reason we've been in the process of getting permissions, we've gotten permission from this group already, to realign our equity portfolio to take out the small company bias. And as we're in the process of getting those approvals, it slowed down our rebalancing effort a little bit so that we could be efficient. That is now passed, everybody's approved it, and we've done the first tranche of rebalancing where we will not only be bringing developed equities down a little bit, but we'll be bringing the small cap, large cap tilt closer to the neutral that we promised you for. That should come to a conclusion with the next rebalancing or two, and we'll be totally in line on the equities. On the fixed income, we have the same bias that we've had for a number of months now, with us being underweight long-term core plus 5 bonds and overweight what we refer to as cash, which is anything under 4 years duration. In the cash, we're actually holding treasuries with about a 2-year maturity rate, which when combined with the core plus 5 leaves us with a duration or interest rate sensitivity very similar to that of the broad bond market as measured by the Barclays Aggregate Index. We're also underweight TIPS for the same reason, and more or less neutral the other asset classes. I don't have a lot to say. I'll let Martin comment on February and give you a sneak peek at March, and then we will go into a diversity proposal. Martin?
Yes, thank you. If I could ask you to turn to the page that shows retail sales, which is on page 10. So we've had growth in the economy. The GDP numbers are going to come in, I believe, on Friday. The estimates are for flat growth, 1.1%, I believe, is the consensus. Hard to do the weather, hard to do the other things. And this is an example of that. While we have a recovery that's on an annualized basis, has been for several years about 2%, we have mixed signals. And this is one of those signals where you see retail sales going down instead of going up, as you would expect in the recovery. So when you turn to page 11, which is auto sales, the number 1705, first of all, the trend obviously is good, it's up. 1705 being set on an annualized basis for the month. If you annualize it for a year, it means 17 million vehicles, new vehicles sold. That's near the high, which is very close to the all-time high if you take this back forward, it shows 5 years before pre-crisis. So you have mixed signals. And then the last number I'm going to show you is on page 13, which is inflation. We printed this right before the very most recent inflation print that came in, which was actually at negative 0.1. And so the Fed, which is expected to raise rates from its current policy of effectively 0, originally the market was expecting June. So the market participants thought September. It's now an open question. I'm not sure anyone really thinks June is the answer as to when they're going to move. And also because of this mixed message, I didn't go through the employment numbers, but we talked about before with employment, while it's improving, and you see the unemployment, the headline unemployment level in the mid-5s, is the participation rate and wage growth, which is not as robust as the Fed would like. And so raising rates, the concern is, would damper that tepid response that we're getting in employment. I want to go through some other numbers here very, very quickly. Page 21 shows in red high yield spreads and in blue investment grade spreads. It's hard to almost tell, but we're at 466 at the end of the previous month. We'll update this obviously next month.
So what page are you on?
21. So red shows high yield spreads. That's the amount that the yield is above the maturity equivalent treasuries. The blip up before the 466, that was when energy was going up in spreads and down in price because energy prices were going down in the fourth quarter and the first quarter. As you see, the markets calmed down and spreads have come back down. Well, it doesn't look like a whole lot of blip. Inside the market, energy was one of the best performing sectors in the past few months because of the bounce back, at least in the market. There are energy companies, pure E&P companies, that will have trouble over the next couple of years if prices stay in the $50 to $70 range. But for now, the market is moving ahead. And the reason the market's moving ahead is, aside from the initial knee-jerk response, which is this is bad, the market is then saying, market participants are saying, I need yield. And so market participants, again, are buying, not just retail investors, but institutional investors buying energy, which is an important part of high yield, and high yield in general as well. A couple of other pages I want to point out to. Page 25. We showed this later on. This is a graphical form. It's just easy to see the past year's worth of returns for in white, the U.S. market, Russell 2000, in orange, developed markets, IFA, in yellow, emerging markets. And you see this has been going on for several years. The U.S., which is growing at a lower rate than the Fed would have hoped, and the Treasury would have hoped, and the administration would have hoped, and everyone here would have hoped, is still better than what's going on in Europe and other developed markets. And so that is reflected in the stock prices that you see there. February returns, if you turn the page, it's hard to read on the top, it's page 27, it looks like this. Just turn 2 pages. You see the actual returns built into the number. And the Russell 3000, the first column of numbers on the left, returned a very strong 579. The next set of numbers on the top shows IFA and emerging markets, as well as NYCERS custom benchmarks. Those are strong numbers. Hedge funds did a good number, as shown on page on the third set of numbers. And the last set of numbers, if you look at the Core Plus 5, that was down, because during that period of time, interest rates actually went back up. They've since come back down since. And the next page shows high yield, leveraged loans, tips, and convertibles. All numbers are strongly positive, except for tips, because they're connected to interest rates, which went up during that period, and therefore the prices went down. So what did that mean for February? If you turn to page 31, which is the charts with the bar on the left, the monthly return was an extraordinarily positive number of 283. If you remember last month, I told you to expect a good number. And so that brings the fiscal year-to-date number to 1 basis shy of 3.5%, mostly being driven by U.S. equity. If you turn back the page now, what happened, our hint of what's coming for March. While we don't have the exact number, I can give you two numbers. So you see the actual returns for March. The equity market pulled back a bit in the top section on the left. Russell 3000 down 1.02. Both emerging markets and equal were down. 4 plus 5 was up on the bottom, 53 basis points, because that's, as I mentioned, interest rates back down into the 180, 190. And high yield went down a little bit. Leveraged loans went up a little bit. So I would expect next month's numbers would be slightly negative, not a big negative number. I will tell you that what Scott mentioned about the rebalancing, if you take a look at page 32 again. While he mentioned this, I also want to say for the record that while we were beyond the rebalancing point in tips for the month of February, in our rebalancing where we reduced the green and the yellow, we got that back into the balance, back into the bar chart. So we're back in balance with all policies for the NYCERS system. That was part of the rebalancing. One last thing I want to show you, if you turn to page 37, this is a very good piece of news. The February number is a new, I believe, record high of just shy of 55 billion for NYCERS. The chart here shows the 1 year period each month. The chart on the next page is page 38, and that shows year by year for the last 10 years with the last month of that 54.9 billion. And it shows on the bottom the 10-year number as of February was 699. So it's right on the expected actuarial number that you're trying to achieve. And the last thing I'll tell you is I ran the numbers as of yesterday. This is completely unofficial, but you'd be at a new record high. Even though I told you that March was a down month, April has been a very good month. You've been reading that the markets hit a record high. That happened in the first couple of weeks in April. So we've made up the March, whatever the small March loss was, and we're now at a new record high over 55 billion. That's as of yesterday. We'll see what comes out at the end of it. We still have a few days to go. In the manager benchmark comparison report, as we call it, the red and green numbers, it shows all the managers. In fixed income, I can tell you the managers are generally doing well. Well, we do not have in this book. It should be in the next book. The input transitions will be in there. One of the reasons we're very pleased in how it went is because it didn't affect the numbers, because it was planned out very well, executed very well, and we also got lucky in the timing when we did the trade, which is unknown if we do it, but in retrospect, it was a good day to do the trade. Those are my comments on this report. Are there any questions?
Questions for Martin?
Can you go back to this question about hedge funds? You went a little too fast for me when you said that in one area there was a positive game and the other one wasn't.
Are you referring to this chart here?
I believe it was on page
27?
27, yes.
182, yes. That's the benchmark. So there's HFRI Fund to Funds Composite plus 1%, which is the benchmark, and that was a strong positive number. We do not know how our funds did versus that. Actually, we do know, it's in the book, how our funds did versus that. But for the month, it was a very strong month for the hedge fund program. That's what I was referring to as being positive.
You're just talking about the different parts of the market and the hedge funds having
Right. What I don't understand is the question of whether this applies to, whether you compare us to the sector.
So for to see what the actual number was, that's later on in the what we call the manager benchmark comparison report. Sorry, I don't have my reading glasses on. I need to have one on page 50. Okay, so page 50, turn to page 50. The hedge fund number was 166 versus the benchmark of 182.
So it was down 15 basis points. And remember, that the hedge funds is all net of fees. And so net of fees, it's underperformed 15 basis points for the month. It's outperformed about 100 basis points fiscal year to date. So that there you can see how it's doing relative to that index.
And we're looking at the bottom of page 50.
So on an absolute basis, it was a very strong number. Now remember, the comparison that we're talking about, which is the benchmark, is a fund-to-funds composite, which has fees, but also adds 1% on top of that. So we have to beat that bogey on top of just the fundamental stuff.
And we go, Henry, into detail on each of the asset classes and their performance every quarter when we come in front of the board. And I'll have the asset class heads here, and they take you at depth through each of their performances. That's where usually kind of get into the weeds of it.
And that's a good point, because in June, next month we'll show the March quarterly numbers in this report, and the following month in June we'll go through it in more detail in the quarterly report. But also I just want to show you on page 50, not only does it show the program, it shows each individual manager.
And just as a final clarification, you said these are net of fees, or are you going to be doing net of fees?
Yeah, so for the private asset classes, including hedge funds, they're net of all fees. For the public asset classes, active equities, active fixed income, predominantly, they're gross of fees. And that's a historical precedent. After examining it, we can't find a good reason for it, and so we're changing it to net of fees because it just makes the comparisons difficult. For instance, if you look at the public fixed income or public equities, it doesn't show you what the effect of fees was in the performance, and you need to look at that to see if the active manager is overcoming the extra fees in his or her performance.
And when you get the quarterly report, in the past, instead of showing each manager net of fees, we've shown gross of fees, and there's an appendix that shows what the fees are for asset classes. So it's up to you to do the math. We're going to change that and show net gross.
Too much math to do in our heads.
Go ahead. Yes, on page 16, so much of the macroeconomic data that you provide is U.S.-centric, and clearly we've invested a lot in emerging market debt and emerging market and IFA. One of the concerns, obviously, to a portfolio like ours is the sizable FX risks that are associated with our portfolio, and clearly the euro to dollar currency exchange has dropped off considerably. Not specifically with our portfolio, what is the outlook of BAM as to our exposure? Clearly, there's always that debate on overlays and the expenses associated with it, but what kind of risk management, what kind of things are you doing to look at, what our total exposure may be, and how do we?
So we absolutely take a look at that in the equity portion of the portfolio where we invest overseas. Since the long-term expected return from currency positioning is zero, and the movement of currencies is one of the contributing factors to providing diversification from the return patterns for U.S. equities. It's actually a desirable characteristic that the currencies are moving at different times. So we, as a policy, as a BAM policy, do not do an overlay. We don't hedge the currency risk over time. In the U.S., these are U.S.-centric portfolios with U.S.-denominated liabilities. If we had the great preponderance of our investments overseas, as many European pension funds do, we might look at it differently. But here, we take it as part of the risk that we take on in equities outside the U.S. We do have some managers that, for tactical reasons, do their own overlays and want to hedge currencies. We have some of this in the fixed income area as well. We don't interfere with the manager's tactical desires, but our structural desires are to not hedge the currency.
I also want to mention it's a basket. So Bud can tell you that compared to other public pension funds, we have, because of the basket constraints, much lower allocation overall to non-U.S. equity versus U.S. equity. In other words, it's basically 2 to 1 instead of being closer to 50-50. And secondly, the hedging itself goes in the basket. And so not only is the asset class itself in the basket above 10%, but the hedging as well.
And also, about a year and a half ago, the board asked us to do an evaluation of what exposure NYCERS had to non-dollar. And we determined it was about 21, 22% at the time. And we felt that that was a low enough level where we didn't think that it was desirable to hedge. And that if it got to 25% or more, we would consider it a good idea to hedge at that point.
And given the precipitous fall, was that a smart decision at that time?
Well, again, for the reasons that Scott talked about earlier, the diversification benefits over the long term are still desirable to have. Now, we're never going to know where the value of the dollar versus the other currencies is going to go, but long term, as a strategic hedging strategy, we determined it was not desirable.
All right, thank you.
Okay.
Thanks.
All right, thanks very much. If there are no further questions, why don't we move to the diversity proposal that we have for you, and that's on page 74.
I have extra books. There are 3 extra books.
The big book. I'll give a minute for everybody to go to page 74 in the big book.
Did you pass this down to?
I have one more book.
What's yours? You have what?
24.
I have no more books, but I have a public book. I have no more big books, but this is...
Yeah, it should be in the public book.
Here is it?
One,
I'm not sure.
I'm sorry, we have one more. I'm sorry. Yeah.
This is her. Yeah.
I will take it back.
Thank you.
Okay, thanks very much. So we have a 4-point proposal, 2 of which are things that the Bureau of Asset Management, under the direction of the New York City Controller, plans to do, and we wanted to inform you about it. The second 2 are things that you can do, but we need your approval. And both types of proposals have to do with diversity in the asset management pool of managers that we use. So what we plan to do is to begin to evaluate the diverse population of existing managers and prospective managers across asset classes, and to recognize those managers who have strong diversity profiles. So, of the prospective and existing managers, we're going to look not just at the small managers, our emerging manager MWBE programs, look at the small managers. We're going to look at all managers to understand their diversity profiles. And we will recognize those managers that have strong diversity profiles. In addition, with your permission, we would like to integrate diversity into the consultant searches and into manager selection. And we hope that this will promote consideration of diversity in decision-making by institutional investors in manager evaluation in general. So those are the proposals. Let me talk about why we're doing this. And there's really a one-sentence answer to why we're doing this. The truth is that diverse groups of decision makers make better decisions. That is a fact, proved by a number of studies. Diverse groups of decision makers make better decisions than homogeneous groups of decision makers. If we all think the same, if we all come from the same background, the same perspective, have the same beliefs, and we're sitting around the table, we're talking to ourselves. If we come from different walks of life, different perspectives, different geographies, different ethnic and cultural backgrounds, we have a rich and diverse group of decision makers, and they tend to catch errors. That's what the studies show. They particularly tend to catch errors when the group begins to draw conclusions in a group way in which they're not examining other perspectives, known as group thinking. And this is one of the biggest risks in investment management, because what is investment management but decision groups sitting around a table debating issues, debating buying and selling securities, debating the merits of currency strategies and business strategies. If everybody thinks the same, they're very vulnerable to groupthink. So I show on the next page a bunch of studies that have been done, recent studies, National Academy of Sciences, the New York Times did a big exposition, McKinsey and Company, Credit Suisse. They take stylized groups and they divide them into heterogeneous and homogeneous groups, and they show through some stylized studies that the heterogeneous groups make better decisions. That's National Academy of Sciences. They show, looking at cross-sectional information against different types of businesses over time, the diverse companies that have diverse leadership have better financial returns. That's McKinsey. They look at male-female attributes and find a benefit to women being involved. I actually didn't need to study for that. I can just look at my own family growing up. I have a brother and a sister. If I try to make a decision by myself, I was prone to make certain errors. If I included my little brother in the decision making, we would fight a lot. We would debate and debate and debate, but we basically thought the same, and we basically come to the same conclusions. My sister was in the mix. It was a new ballgame. She thought differently. She wasn't prone to her older brother's influence. She had a different perspective, and generally speaking, we made better decisions, particularly when the decisions involved parental oversight. And so these studies show what we know already, that when you have men and women, when you have people from different perspectives, you get a better decision making. So easy to conclude that in the investment management business, when we look and see how investment management companies structure their decision-making teams, they should lead the world in diversity, right? Not so much. When we look at, let's just benchmark. Let's look at the population, both the national population, where the minority will actually be a majority in the near future, on page 77. And if you look just at the New York City population, New York City, white members of the New York City population are about 35%. Just kind of gives you an idea of how many white people there are in the general mix. And then we'll flip to the next page where we can see the white and male populations in the asset management business. And it is whites and white males that are the issue in the asset management business. It's not a diversity problem, it's a homogeneity problem, because there are so many whites and white males in the business. 83% of portfolio managers are white. 82% of senior portfolio managers are male. In hedge funds, 97% of hedge fund managers are white males. So it's a homogeneity problem. And given this vulnerability of these, this is a high priority topic for us as financial stewards when we select managers, to make sure that we have in the mix. When we do our due diligence and we look for positive attributes, we're looking for a strong track record. We're looking for good operational skills, a succession plan. We're looking for a repeatable strategy. I think we also ought to look for a diverse decision-making team. Now, the law will not allow us to have specific targets and that sort of thing, but it is absolutely allowable to score people based on the diversity of their decision-making team, and then have it as part of the mosaic when we assess the strengths and weaknesses of teams. I want to be very clear, we see this effort to evaluate all firms and the diversity of all firms as an expansion of our existing focus on minority and women-owned enterprises. We're very proud of the fact that $11 billion, almost 7% of the portfolio, is invested with minority and women enterprises across the 5 systems. We don't plan to take our foot off the gas at all there. All of these efforts would be to go beyond and focus on diversity at all the other firms, so that when we talk publicly about our diverse content in the New York City plants, we would talk about the MWBE and diverse managers. And it's this diverse manager designation that we're talking about today. We'll have a new definition. It will be relative, and this is for sort of when we talk about it publicly. We will designate large firms as being diverse, and they'll be diverse relative to the industry, because the industry is not very diverse. And we'll hope that this will provide positive incentive, and it will certainly allow us to distinguish those firms that are taking diversity quite seriously. And for all the reasons that I articulated, we believe that people who take diversity seriously are improving their chances of making money for the 5 pension systems of New York. With that, when I open it up to questions, I would like at the end to get your feedback. While you don't have to vote on this today, I would love to go into our manager meeting later this week, saying that NYCERS has integrated this approach into our underwriting process, but that is, of course, up to you.
Mrs. Green?
Thank you. I just want to understand, as far as first of all, it's excellent to hear you say that. I'd like to understand, what is the pool right now of the number of managers in the category of MWBE that have applied,
Okay.
that have participated?
Yeah, so it's about $11 billion of our $160 billion under management.
Right, but those are the ones that have been selected
Correct.
to do business.
Correct.
I'm referring to just the volume of...
Well, how many MWB firms are there out there?
Correct.
I don't know.
That would qualify.
Yeah, I don't. Well, see, we're in a constant process to find the best managers, and finding the best managers is a holistic process, and then we will look at the managers and say separately how many of these firms are diverse firms and how many of these firms are MWB firms. We do have emerging manager programs where we have allocated funds to emerging managers, and here we're just talking small managers. It is a case that many minority-owned firms tend to be small managers, so there's an overlap between emerging managers or small managers and MWBE managers. But when we talk about diversity, we talk just about the latter, about
Sure.
MWBE. But I don't have a figure for you on how many are out there or how many have attempted to do business
And
with the
Scott, that's exactly what I'm trying to get at. It's important that we start off with understanding our inventory in the city of New York, as far as who are those firms that are certified right now, who would qualify under these specifications that we are going to be voting for, so that we have an understanding as to, are we talking about 200 companies that exist right now? Are we talking about 50 companies? Because the volume and the probability is going to determine an outcome.
I see what you're asking. Okay. The diversity program that I'm talking about is not just focused on MWB firms. It is focused on all firms.
Right.
So J.P. Morgan,
correct.
Would be one of the firms that could be considered not a small firm.
But their diverse management team,
Correct.
right? We don't know what it's comprised of, because this is the first time that we're actually asking.
So what we're going to do, if I can take a little liberty with your question, how are we going to figure out whether J.P. Morgan or Goldman Sachs or Morgan Stanley or any of the firms that are coming in front of you today are diverse, or practicing diversity. We'll do it on 3 levels. The first level will be to take a look at their board, or their operating management as a private company. At the top level board in the corporation.
The board of directors?
Board of directors, correct. And to see how diverse the board of directors is. We already do this as part of our corporate governance initiative. We're sort of restricted by the data and what we can look at. We will ask fulsome questions about the composition of the board of directors in terms of the EEOC categories, which divide the population into sex and gender and ethnic background, etc. And we'll look at the composition of that group. And in looking for diversity, you want to minimize the dominance that any one group would have in the population, right? So it's typically in our business white males, and so the lower the participation of the top group, the more diverse the organization will be. We then want to look at not only the board of directors, where there's been more progress made than elsewhere in asset management firms. We want to look at the investment professionals themselves, and specifically the investment teams across any company that are managing assets for clients like the City of New York. And so we want to take a look at that whole investment decision maker population and see how diverse that is. And then finally, because the rubber meets the road in asset management firms always with compensation, we want to make sure that the diversity of compensation is similar to the diversity of the population among investment professionals. So we'll look at those three dimensions, and then we will compare all investment firms to the population in general, and we'll single out those that are distinctive in terms of having way above average statistics. So that's specifically how we'll do it, but the population is all managers.
Well,
so all managers, and if this is a fundamental part of our manager selection process, providing that data will be one of the required elements of participating in a search with us.
And I appreciate the breakdown of that. So right now you have more or less, because you said you've always taken a look at what would be the board of directors composition. You would have somewhat of a preliminary assessment of the data sets.
So with Mike Garland will tell you that there is a very good data about how many women there are on the board, but beyond that it gets tricky. So one of the things we would have here would be hard data on that in terms of the EEOC categories across the board, and the investment manager data does not exist. There are other states that require this as part of their procurement process. We have dialogue with those states and to see what they're asking and so forth. We would come back to you, of course, with the specific questions and the specific data. What we're looking for is an approval of concept. To integrate this into our procurement process, and we would then come back with specific.
And I just have my last question in reference to asking these firms, the number of H-1B1 visas issued by, as far as employees within their companies that would be categorized under what would be a diverse composition of employees.
Right, to get to how many folks were given special visa status from other countries.
To fill these positions.
Yeah, that's not part of our proposal.
And is that something that can be?
We could talk about it, but it's outside it's outside the lens that we're using at the moment. I would have to sit back and study that to understand if that I'm not sure the angle that what angle we look at that from the perspective of maximizing the returns, risk-adjusted returns for the portfolio. Here with diversity, different perspectives, you can see that it lends itself. You could make the argument that having people from different cultures, different perspectives is beneficial to diversity in the portfolio.
I can appreciate that. My concern is using the H-1B1 temporary status as filling what would be these levels.
And that's, I believe that's a distinction that is beyond the investment determination.
Nonetheless, one of concern.
I understand, but what we have to confine ourselves in the structuring of our procurement process, in making determinations about managers and so forth, to issues that are directly relevant to our fiduciary duties to put the best team on the field to provide risk-adjusted return for the 715,000 beneficiaries of the system.
And I just want to make sure that we understand, there's almost 4,000 issued H-1B1 visas in the city of New York for the financial sector in the city of New York. And those are all temporary visas that can fill what would be the mandate of a diverse composition of individuals within these companies to maintain what would be procuring with the city of New York, with our NYCERS system.
So again, it's not an angle that we've considered. I'd be happy to think about it, maybe discuss offline, and then come back to the board. But that is not part of the proposal that we have to you today.
Thank you.
Mr. Reno.
Yes. First of all, I want to commend you for this. I think it's a good, not only a great initiative, but it's long overdue. My question is, on your procurement policy, you have weighted percentages that you assign to those who are coming, and you suggested that either one of those categories of percentage, whether it's the 30% or the 40, would be adjusted to reflect diversity as part of the institutional capacity, or that you're adding a category that wouldn't have an added value per se on the evaluation of the percentages.
No, it's going to be while we'll have a score for diversity, we have to have some way of comparing one firm to another. That score can't be formally integrated into the weights of the procurement. That is illegal. And so we've had lawyers take a look at this. Michigan University, under a famous case involving the current president of Columbia University, Lee Bollinger, got into this with admissions, college admissions, and to what extent you could have formal percentages in the procurement process for students. Our lawyers have looked at this, and as a result of that precedent, if I say any more, I'm in big danger because I'm not a lawyer. I don't even play one on TV, although I'm playing.
And we're still in the public session?
Yeah, I realize that. The goal here is to do something that's within the confines of legality. Obviously, everything we do is within the confines of legality, but that will require, Henry, that it be qualitative assessment, just like track record or succession plan. It's something we look for. It's something that is a favorable attribute, and we believe a diverse decision-making team is a favorable attribute. But it will be considered, that diversity score will be considered as part of the mosaic, and we believe we're on safe ground there in terms of the way the laws of procurement run.
Ms. Stryker.
Yes, I like the idea very much, and I'm very delighted that you brought it to the board. I've been talking about, my focus has been females for years, people who know that. But I think the firms already know that this is underway. And I think they're very clever in who they decide to hire and put in positions in the firm. And then I'm thinking of HR. That won't satisfy. Or, no disrespect, but they put in attorneys, female. And then the people who actually make the decisions and make the money are not female. So I think we have to hold their feet to the fire and make sure that they're doing something that we really want and not just to try to placate us and do minimal stuff.
So, Pat, excellent
That's a good
points.
point.
And this is exactly why we've structured the program the way we have. If you notice, they can't simply fill up a table with people that look like the United Nations in order to give the impression that they have a diverse decision-making team. We look at who's on the investment committee, right? So, typically speaking, managers will not put people in a decision-making role unless they're competent to make decisions. And we do an additional test, which is what are these people being paid? So if you have a very diverse decision-making team, but in looking at the composition, you find out that white males take home 95% of the compensation. That kind of tells you that there's an issue with the diversity of the team. Because as much as investment firms will want to do business with New York City, California, and other public systems, they will not contort their compensation scheme. That is the that is the ultimate test for an investment firm. They will not mess with that. They would rather not have the business because it's fundamental to driving incentive in an investment team, and that's exactly why we need that data to understand. Now, we will structure the data. We'll have a consultant that will collect the data. The details of the data we will never see. We'll only see the aggregate, by category, because we want to protect the confidentiality of the information. We don't want public disclosure laws to compromise people's privacy. However, we do need to see this aggregate data if we're going to understand the true diversity of the organizations.
Madam Public Advocate.
Yeah. So, in the absence of a disparity study, I don't know how you get at integrating diversity in your searches and in your manager selection. How do you get past the absence of a disparity study, which is basically required by the courts?
I'm not. Tell me a little bit more about.
So all of the decisions with respect to diversity require that you do a study to determine the impact, so that you have so you can justify increased minority participation. In the past, as a member of the City Council, council member, and I, Diana Rayner and I, we were part of increasing procurement opportunities for the City of New York. And based upon our analysis, it was required that we did a study so that we could determine which companies had a diverse board, had a diverse staff. That was a factor in giving them an extra point, an additional score. So on its face, this is not race neutral, this is race-based. And so given a race-based type of analysis, I think you're inviting problems.
So the...
that one, and two, the other issue, which really goes to Ms. Stryker's issue, consistently what has happened, as the council member and deputy borough president and I know, what usually happens is diversity is defined in the world as not people of color, but women, mostly white women. And it continues to be an issue. So that's how they justify or they demonstrate the diversity.
So I'd be happy to talk with you more about the difference between what we're doing in understanding the diversity and the decision-making teams, and a disparity study, and what proceeds you might get, so that we there might be aspects of a disparity study that would be useful to integrate into the study that we're proposing. So we'll be happy to talk with you about that. But I want to be clear that we're not saying that based on the results of our diversity study, we will take specific actions. That's not what we're saying. And I think there's a difference there from some of the procurement programs that say, we're going to do X with various things. All we're saying is that we consider it to be a desirable attribute based on a variety of studies that have shown that diverse decision makers make better decisions. And we're talking about when you look at it, it's the lack of homogeneity in the group. It doesn't have anything to do with any one particular group. It's just that you have a variety of perspectives, and that's good. Other things being.
And I think no one in this room disagrees with
Right.
that analysis and that observation.
Right.
And I think we all can agree that the goal is noble.
Right.
The question is, how do we achieve it
Right.
without violating the law, one,
Right.
and two, how do we get around what Councilmember Rayner, Deputy Borough President Rayner and I have seen historically,
Right.
and that is the individuals and companies historically get at diversity by promoting women and primarily white women. And that's how they get at their issue of diversity, and that's it.
Right.
So that's it. So there's a legal issue that we've got to get at, a hurdle, and then obviously get around some of the barriers and some of the ways that people try to address the issue of diversity by not really promoting diversity and not reflecting the United Nations as you stated. Two, the issue is, at what point do emerging managers promote to principal managers, if you will?
Yeah, so the emerging managers thing is a different program. It comes from a different place.
Yeah.
The intersection is that there are an awful lot of emerging managers that are diverse, and this is one of the principal reasons that we got involved in emerging manager programs, because what we're finding is that a lot of these smaller firms were not having a chance to access big pools of capital like ours. We, as I said, are not going to pull back at all on these programs, on this effort. In fact, separate from this effort to understand diversity in our investment decision-making teams, we plan to introduce or asking for an adjustment to the procurement rules so that we can graduate managers. Right now, a lot of our small emerging managers, MWB managers, are in fund-to-fund structures where they are working for a fund-to-fund. We hire the fund-to-fund. They have to be $2 billion. They have to meet a number of qualifications, which are basically that they're small. And we're trying, we think that it's good to have these managers. We want them to be successful. And as soon as they become successful, they're no longer qualified for our program, but they're not large enough to be picked up by the consultants, so they're sort of
so they're in this amorphous space.
I'm getting to that.
Yeah.
Just give me a second. And so what we do now is we have this developing manager category, and that has not worked very well. It's an artificial category. Nobody really likes it. So we're replacing, as I've explained to the boards and discussed with the boards over the past couple of months, we're replacing that with a graduation policy and a change to the procurement rules that will allow us to reach into the fund-of-funds and graduate managers that the BAM and our consultants believe are deserving managers with strong track record, strong structures, strong decision-making teams, etc., and contract with them directly. And that contract will last until the next procurement. In the next procurement, they'd be eligible for consideration. In the meantime, the consultants, Kellen and others, will have gotten an extra chance to get to know them, to understand their dynamics, and in that period of time, we've essentially given them much greater familiarity to the consultant pool, so their chances of being hired, their chances of not being hired because of lack of familiarity go down considerably.
Yeah,
so that's the plan there.
Yeah, I would like to really focus on this graduation process, if you will. I think that would go a long way in addressing the issue of WMB, even though the summary of your proposal in recognizing the value of diversity, which is a report card as far as I'm concerned, which is a great idea.
Right.
I just want to make sure that we do it consistent with the law too. The idea of promoting more emerging managers, I think, is the way to go.
Yeah. So we're sympathetic in both cases. I would suggest that if you all are positive on the notion that we would attempt to integrate diversity considerations into our procurement process, that we work with you in the intervening time on some of these issues that you're familiar with to make sure that the direction we're moving is not going to run into quicksand. We appreciate your counsel on this. I don't believe we've worked with our attorneys at BAM, but we'd be happy to work with you to make sure that our direction it doesn't have any considerations that we haven't thought of, and we'd be happy to do.
And lastly, the $11 billion that you mentioned earlier, is that mostly in emerging managers?
It's in MWBE firms. So the
Can we break that?
MWBs is small managers. I'm sorry, emerging managers are small managers. MWB, it means that the ownership of the company is minorities or women, and it's that latter category that we focus on. So there are small and large MWBs. For instance, Vista. Robert Smith was once an emerging manager. They're a huge manager now. They're in that total. It would be the most extreme example of
And if I could just say as a follow-up, we've made a lot of progress on the graduation policy with the PPP board, just in terms of getting it onto their agenda, and we're actually going to circulate a letter, I think, this afternoon, so you'll be getting an update on that. And we could certainly use everybody's help and support if it's something that the board wants to do with the PPP board.
Ms. Velasquez?
Just a clarification. So if you're an emerging manager, and you said they have to have $2 billion. Is that what was the threshold?
It's different with different asset classes, right? But
okay.
Generally speaking, emerging managers are small.
Right. So, but I guess what determines for each asset class that bar? So, like, for example, when the public advocate was talking about contracting and MWBEs, we know that for MWBEs that are in our MWBE program, how they are defined as MWBEs is driven by the Small Business Administration, right? So the feds. So I guess I'm trying to figure out where those bars are set, like what. So
we come to you each year with the annual plans on that. And in the case of the fund of funds programs and emerging managers, it's built into the IPS and so forth. It's slightly different, so I'm going to tell you it's generally the case. They generally have less than $2 billion in assets under management. They generally are new. In the private asset classes, they'd be in their first, second, or third fund, and their total assets under management would be below some threshold. That's fine. Those are the funds that have trouble getting access to people with the graduation policy. We're trying to allow them to grow because, in fact, you want them to grow, and so you don't want them to lose qualification just because they grow.
Okay, so you answered my question. So you don't actually have some place set in stone what that looks like for every asset class. So it actually gives you some flexibility
when you go to the PPP
Right.
board, when you're trying to change the PPP rules and you go to the PPP board, that you're not trying to do something that is different where it's set someplace else like
Right,
that.
emerging manager thresholds aren't set by an outside entity.
No,
like
that's what I'm
small
trying to
business
figure
organization.
out.
That's
Right,
That's
okay.
Mr. Sanchez?
Thank you. I just wanted to say that this is a great thing. It's a step in the right direction. I'm fairly confident that I think NYCERS out in California does something very similar, where they do have a diversity assessment of all their managers, not just WNBs and then emerging managers and so forth, but an actual, say, show us what your organization diversity composition looks like. My question, I got 2 points after that. But this is a good thing, step in the right direction. I think NYCERS does something very similar already. If you're looking for other funds that do this, so we wouldn't be the first. In terms of the process, in terms of the evaluation, I mean, the board obviously and the investment committees are places to start. But we should also be talking about, how many managing directors, how many CPAs, how many of your FINRA registered representatives fill a diversity profile. I think that should be considered in terms of what the matrix and the scoring criteria will be, CPAs, lawyers included, because often people who are lawyers end up on the investment side, not just in the recovering lives of attorneys. Lastly, in terms of the H-1B1 visa information, a lot of that information is out there. You can look up how many visas Google has, how many Goldman Sachs has. I've read this. I've read the data out there, reports on it. And to your point, I'm not sure if that really helps the analysis we're trying to get at. But I do want to make that clear that I know I've read that and that data's out there, and you can go even compare by reason, looking at New York City and which employers are having how many visas versus San Jose and Silicon Valley and so forth. So a lot of that information is public and been researched and written about very thoroughly. That is all. I need my coffee.
Mr. Rito?
Just a question. You are required to follow PPP rules. Now, so on the PPP, there's an Executive Order 50, which requires that diversity already in there by those firms trying or soliciting or bidding for city contracts. So I'm wondering why that hasn't been there to begin with all the companies that are bidding for your services.
Specifically, what is 50 required?
Executive Order 50 requires exactly, so it's almost like an EOC account on diversity of the workforce of anybody with more than 50 employees.
Yeah.
And it's part of the certification requirement on the PPP that any prospective bidder would have to submit, just like bonding or anything else, as part of the pre-qualification to be a vendor for compliance. And I'm wondering if that's already there, or if you're exempt from that, or those who are bidding for the financial services are not covered by it, because I haven't seen an exception under the PPP rules.
I know I was going to regret doing this. I told Jimmy Annie he didn't have to come to the meeting today. I had it, and you just asked a question that I believe he could answer, and I cannot answer. But I do know that the filings that these EOC filings that these guys have to do not give us the grain structure of information that we need to make this determination. And I believe it has to do with the designation of who's on the investment decision-making team, and then the breadth of compensation. They get exactly to the questions that Pat Stryker was getting to. That with the current array of information, it's difficult to ascertain whether the actual decision-making teams themselves are diverse and whether the power on those decision-making teams is dispersed.
Okay, so you are looking for a vote of the board to do what?
So what I'd like is your agreement that this board would like to integrate this proposal into our manager search process, pending the details, approval of the details, that will come back to you as we do with any procurement. So as we go into a procurement that would include this, we'd be happy to show you the questions and other things that are part and parcel of the process, so that you can know the specifics. As you can imagine, we've got 5 boards to contend with, and there's a spectrum of reception to this topic. And so what I'd like to do is to figure out, which boards would actually, like to integrate this. And if I have enough boards, then we'll go ahead and work this out. So far, I've had a few boards that have said yes. I think you guys would push us into, being ready to move full steam ahead with integrating this. If you don't want to, we'll probably do it outside of the procurement process.
Okay, so let's see if there is a motion to integrate the controls proposal into the manager search process for NYCERS along the lines that Scott described.
So moved.
Is there a second?
Second.
Okay, any further discussion? Okay, hearing none. All in favor of the motion signify by saying aye.
Aye.
Any opposed? Abstentions? Okay, the motion carries.
Resolution number 1.
Resolution number 1. Thank you.
Okay, thank you very much, everyone. That concludes, Mr. Chairman, our remarks for the public session, and we'd be happy to move into private if you're ready.
We have a motion to move into executive session.
Motion.
Is there a second?
Second.
Any discussion? All in favor of the motion, please. Opposed?
No one has ever voted.
Abstentions? Okay.